Hello and welcome to Fintech Insider Insights. I'm Benjamin Ensor, Director of Research and Strategy at 11FS. Today, we have an extra long edition of Insights. We've dug into our archives to combine both parts of our series on how to buy a bank. Recently, we've seen Nationwide Building Society in the UK approved for a £2.9 billion takeover of Virgin Money, while American regulators mull over whether to allow a $35 billion Capital One and Discover merger. So what really happens when one financial giant swallows another? Why do they do it? And what technical and organisational shifts need to happen to make it work? Our CEO, David M.Brear, spoke to Polo Rocha, reporter at American Banker, and Virginia Varela, a community bank chief executive and former federal regulator.
Hello and welcome to Fintech Insider Insights. I'm David M.Brear, CEO here at 11FS. Now, you might remember last year we discussed how not to build a bank. Well, today what we're going to be doing is bringing you a new two-part insight special on how to buy a bank. We have already seen the headlines on both sides of the ponds this year. In the UK, Nationwide have bid $2.9 billion to take over Virgin Money, while in the US, Capital One hope to acquire Discover in a deal worth over $35 billion. Fintech funding might be going down a little bit all over the world, but big money M&A is here to stay. So in this episode, what we want to do is take a closer look at why and how banks actually make this thing happen. What reasons do banks buy and sell? What really are the processes and how long does it take? I imagine it's not quite as easy as just buying something off Amazon. But after all is said and done, how does this actually impact the customer? To have this conversation, I'm joined by some amazing guests who have really seen for themselves actually how these things happen or seen mergers and acquisitions really up close and personal. Firstly, I'm delighted to be welcomed by Virginia Varela, who is Community Bank CEO and former federal regulator. Welcome to the show. How are you doing?
I'm doing fine. Great to be here.
Yeah, well, you will have seen this one, I guess, from a few different angles in terms of being within the regulator, being within an organization, sort of adhering to those regulations. It's an interesting topic. But for anybody who doesn't know you, tell us a little bit more about your background and why you're interested in it.
Well, thank you for asking. I love this topic. It's fascinating because it's a really pivotal point in an organization's life. And I have an unusual background. I'm a former regulator. So I started my career with the Federal Home Loan Bank of San Francisco as an examiner and then moved into policy and supervision, worked for the Office of Thrift Supervision when the savings and loan crisis hit, was merged into the OCC and later was a Fed regulator. But I've done everything from heading up the applications department and seeing a lot of mergers to being an examiner and overseeing the examination department with a lot of different boards of directors, seeing how they interact and make decisions. And then also looking at policy related to merger and acquisition activity, the application process, and really enjoyed that part of my career, retired, and then moved into the private side. So I've been kind of a turnaround specialist. So I started as a risk officer and moved into the president CEO role, been at 4 different banks. And my role was really to get them in a strategy where they could move forward, get them ready for sale. And all 4 of those banks were ultimately sold. In my earlier career as a regulator, I was also part of the management consignment program where we would go into banks and, manage it as needed or look at FDIC assisted sales. So I've had that experience. Then when I went into the private industry, really with some of these small troubled banks, you're really wanting to set them straight, but always have in mind an exit strategy. So my most recent gig, which I'm still a part of right now, is with Golden Pacific Bank Corp, which was ultimately acquired by SoFi to become SoFi Bank. And that acquisition took place, was finalized in February of 2022. So that I've had an amazing career, sort of like a forest Gump of banking. I've done a lot of different things. So,
I love that. Forrest Gump of banking. I'm going to avoid the impression immediately, but no,
good.
that's a
Yeah.
great. I nearly, I was that close. Like I really was that close. But
Hopefully a few more brains. But I'm talking about the luck.
yeah, I
The
mean, he
luck
got
and the
some amazing stuff
experiences.
done. Yeah, what I've said in my career a little bit. It's sometimes having the luck to be in the right place at the right time, sometimes, and then
That's
recognizing
right.
opportunities, isn't it? But in amongst those crises or in amongst the changes that you've seen in those regulations, I always love it when the producers do a great job and bring on great people, which is good. But all right, well, thank you very much for coming. We'll pick your brains more and more on that, and actually, we should introduce our other guests as well. Polo Rocha, who is the reporter at American Banker. Polo, I always hate it when I go second introducing myself after Jason at our place, because I'm like, what do I? But like, give everybody a bit of an introduction to you, and obviously for our international audience, what American Banker do.
Yeah. To be fair, that's quite an extensive background that Virginia brings. I'm a reporter over at American Banker. Been covering financial stuff for 7 or so years. We are mostly online publication with kind of monthly magazine. We cover the ins and outs of the banking industry. Whether that be the tech side of things, whether that be community banks, big and regional banks. I personally cover kind of the big and regional banks in the country. And then, we've got a really strong policy team that covers, the ins and outs of what's happening in DC. I'm based in DC, so I kind of follow some of that. But, I think where I kind of try to focus is more, the bank earnings reports and really kind of the business of banking and, this M&A topic that we're talking about today.
Very good. Well, it's fantastic to have both of you on. I think we should probably get into it pretty quickly, just because there's a lot to cover. Maybe if we start a little bit with, why do banks buy each other, or why do banks buy banks? I mean, it's sort of an industry that's no stranger to this, really. The sort of heady days of pirates of the high seas and mergers and acquisitions as way to expand from a geographical perspective. I mean, Virginia, you talk about community banks. Actually, community banks getting out of a state into other states and buying regulatory oversight. I mean, there's lots of different reasons, but maybe Polo, starting with you. Why do banks do this? Why would they acquire?
I think really the biggest reason, and I feel like this has been the case for decades, is just kind of keep up with technology. I think maybe 20, 30 years ago, actually earlier in that, it's money market funds were competing for bank deposits, and maybe banks kind of needed to find other ways to kind of keep up and with customers' needs. These days, it's kind of the same argument. I think a lot of fintech companies have these very nifty products that offer all sorts of new services to people, and I think technically run on the banking rails. But if I'm a big bank, I need to compete with those newer, flashier fintech companies, right? And I need to invest, in my technology capabilities. I need to build an app and with kind of the right bells and whistles and keep it updated so it does not look stale in 2 years. And you got to invest in cybersecurity, you got to invest in all sorts of things, and that's expensive. So buying a bank and kind of combining forces, two banks can spend maybe even the same amount of money and have more power. And then if I'm a community bank, which, there's, 4,000 or more of those in the country, I'm competing with the big banks that are rolling out all these tools, right? So you just, I think it's just a need to stay relevant, a need to, keep serving your communities, a need to make sure your customers can keep turning to you. So, just joining forces, I think is really the most powerful way of doing that, and make sure that your spending can go a longer way.
I don't want to be the guy putting the skeptical hat on straight away, but having worked in banking for quite some time, I mean, most businesses or most banks bought, I would say, to acquire market share, but the ROI often gets forgotten pretty quickly. I don't know about you, Virginia, but what's your experience on that? Is it a market grab, as in how can we accelerate the piece, and actually, I mean, do you see the ROI being met from those things?
Well, it's interesting that you say that because every bank will have their own reasons for wanting to acquire or be acquired. And a lot of it is economies of scale. I agree with Polo that, a lot of it will be innovation and trying to stay relevant, but it's also economies of scale. So you're looking at the needs today for a bank or a fintech that buys a bank. They're going to have huge compliance needs, and you don't want to duplicate that if you have to. They're going to want to have combined capital. There could be products. You mentioned, David, geographic location. So you might want to move into different geographies, but today with technology, it is about different products and service lines. So you might want to grab a different product and service lines. Nowadays, we have in the United States, we have credit unions buying banks. And a lot of times, they may want to buy because let's say they just want to start small business lending. Traditionally, credit unions could not do small business lending. Now they can. So they might want to purchase a bank that does small business lending. So there's a lot of different reasons. And as far as the ROI, sometimes it works, sometimes it doesn't. And it's an interesting thing to see why it doesn't. I have some opinions or observations about why the ROI does not go up. But generally, it technically and on paper, you want to acquire a bank and you want to look at an acquisition to result in a better ROI place. But I want to make one other point, and that's that we were talking about why banks want to acquire another bank. Regional banks, small community banks, the credit unions, a lot of different fintechs. A lot of them want to buy a bank for things like, access to liquidity or economies of scale. But I would argue that money center banks, they may want to acquire, but they don't want to necessarily be acquired. They don't need to. So it really depends on who you are as a bank, what your brand recognition is, where you are. You don't. I thought Capital One and Discover were kind of interesting because they both are doing well. But, they might wanna for them, it could be just a combination and of, profiles, and they're getting the economies of scale. But I don't see a lot of the really large money center banks wanting to merge together. I don't know if you have other thoughts, but that's just an observation I've seen.
Yeah, what do you think with that, Polo?
Yeah, I mean, I think, particularly the biggest ones, they legally can't really do more acquisitions without, kind of getting, I think it's like 10% of the deposits in the country. I think if you go over that, you just can't go over that, right? So the major ones, JP Morgan, Bank of America, Wells, they just physically cannot do that without tripping up major problems. Unless, of course, there's a crisis and JP Morgan comes in and swoops to the rescue and buys First Republic out of failure. Then that's kind of the only way that a big bank can do. But, if you think about like a PNC, it's a pretty hefty bank. It's definitely no JP Morgan, no Wells Fargo. They've done some deals to get bigger and they can definitely do those acquisitions. But I think it's getting a little bit tougher with the Biden administration to do those kind of big deals. They're still getting approved in some ways, but, they're taking longer. You just have to, I think, meet a higher bar. So I think there is more skepticism among the banks that can acquire and are kind of big, but not massive. But I think what those bankers would argue is, in the meantime, JP Morgan, Bank of America, Wells Fargo are pretty big, and we need to combine forces so that we can better compete with them. And regulators in DC are allowing that, but certainly making it tougher to do so. And there's other reasons why the banks aren't acquiring right now, the business environment. But I think it's just a tougher environment if you're a regional bank that wants to merge.
Yeah, and I'd say that's sort of echoed globally as well. I'd say, exactly as you say, the only real movement at the top level is when there's some sort of systemic risk happening in the market. NatWest being encouraged to acquire a bunch of things, or Lloyds Banking Group being and then actually we can see. I mean, even most recently UBS with Credit Suisse, right? That was a major problem if somebody didn't swoop in. Silicon Valley Bank with HSBC here and all around the world as well, right? So if they didn't do that, then the broader system would be in a problem. But I guess having seen that movie play out, they typically end up having to shed part of that organization because they are too dominant in the market in that sense. I mean, is a shifting part of this landscape that this isn't just something, and Virginia, you touched on this a little bit, but this isn't just big banks buying small banks. Actually, we talk about the broad banking battlefield. We're talking about, we're seeing Apple buy fintechs in the UK. We're seeing fintechs buying, you talk about SoFi. SoFi's a, scaled up fintech, right? SoFi buying, other financial institutions. Is this a different type of mergers and acquisition dynamic here? Because to your point, Polo, actually, this isn't just a how do we get bigger and, just keep blowing more air into the balloon. In some instances, it could be strategic with regards to technology assets or anything across that. So, Polo, maybe you start with that one.
Yeah, no, I think that's a good point. And, I think as it relates to fintechs wanting to buy banks, there's kind of new acquirers or new interested acquirers. I don't know that the regulatory landscape is necessarily all that friendly to that these days. It might be, and some fintechs just haven't given it a shot like SoFi did. But, I think you really, during this period of high interest rates, I think we've seen the benefits of, say SoFi having a bank charter, right? Because banks have access to core, cheaper deposits. And so they don't need to, when they make a loan, they can use the deposits to fund those loans. They don't need to go out and, sell those loans to investors that are facing higher interest rates and maybe don't want to buy those loans from fintechs as much as they used to. I'll admit fintech lending is not a sector I cover that heavily, but I think it's been like a major constraint on growth for these fintechs whose models work great when interest rates were low. But now, everyone's a little bit choosier on what kind of risks you want to bring on, what kind of investments you want to make, and for higher rates reasons, but also, the economy is so far it's doing great, but certainly there's been a lot of question marks for the last couple of years. So I think there's certainly an argument still for fintechs to acquire banks, but whether that kind of thing can happen in this environment, I'm really not sure.
Yeah. Well, what do you think, Virginia? Is it a different market now? Have we got different players doing the acquisitions than we did before?
I think there are a lot of changes in the marketplace, and like Polo said, there's differences in the administration and the requirements from the regulators. But I would argue too that the whole market is changing in a way that makes it difficult to acquire. So I still think there's a lot of fintechs out there that want to acquire a bank for the benefits of access to liquidity, low cost of funding, the ability to hold loans and credits in your portfolio rather than resell them. You don't have brokered funds, brokered deposits. I mean, there's just a whole lot of reasons why it works. And David, you were talking about economies and, maybe the ROI. But actually, when you become a bank, you all of a sudden have to hire new compliance people, risk people, regulatory issues. So there's really a price point on the cost of a merger and a cost of aggregation. And you have to look at that price point for every bank merger. So I would argue that fintechs are not acquiring banks for a few reasons besides just the regulators, and that's that they don't have capital. They don't have access to capital they used to have. The market's changed. You cannot go out and raise the funds that you used to just, let's say in 2020, 2021, 2022. You don't have SPACs anymore. I mean, it just, the world has changed there. The other thing is that I would say I think there's a realization about the costs that come with banks, the regulatory costs. Right now, I think, I read an article, it's probably in the American Banker, that there's more enforcement being issued against banks that engage in partnerships with fintechs because they're looking at the banks to regulate the BSA and other compliance regulations. So there's a cost to being a bank because you really become like, the police dog in the financial services world because you are more heavily regulated, but you also get insurance of accounts, which I think in the United States, most people understand that there's most customers will say, I want to put my money in up to a certain amount to make sure it's insured. So I would say that there's a lot of different reasons why today's marketplace is more difficult. Another thing is the world's changing. I mean, I used to do a little bit of consulting work, and I had a lot of cryptocurrency organizations that wanted to buy a bank. You had all these cannabis outfits that wanted to buy a bank. So I'm old enough to see that there's trends in acquisitions, and you don't really see that anymore. I don't see a lot of the crypto world. It's dried up as far as wanting to buy a bank. So there's marketplace changes that don't have to do really so much with the regulatory application process.
Yeah, I think a lot of sort of decided potentially sort of getting into banking and buying a bank are quite separate things in that process, aren't they? But so I guess we talk about it in the abstract, but what do the practicalities of this look like then, Virginia, in terms of if somebody wants to get into buying a bank? I mean, I guess it's like anything. It's like a marriage. It's like everything starts with good intentions, right? But not everybody can buy a bank, right?
hmm Well, I used to look at bank partnerships as something like dating. So you have like a blind date, and you go in there and you're looking for red flags and doing your due diligence and deciding, am I going to go to the next step? Am I going to go on another date? What am I going to do? And then later on, is this marriage material? So, it's a whole process. But I will say that when you look at the application process and the acquisition process, it starts very early on. So if you're a CEO and you're at a mid-sized bank, small bank, mid-sized, larger, you're always going to want to have in the back of your mind an exit strategy or a consideration of the stakeholders. To me, the shareholder value is extremely important. And if I'm ethical and want to do the best thing by the ownership, I'm going to look for an exit strategy that will bring them out whole or much better. That's my goal. That's my role as a CEO or as a director. So always you're looking at opportunities. Now, for myself, I will say that fortunately I had boards and myself as a CEO, I was willing to think outside the box. So I was willing to talk to a credit union. I was willing to talk to, fintechs and get a better deal. Where I think there is some traditional mindset in the banking world where, unless it's a very traditional, I don't want to say white male, but you know, I just did. Unless it's a traditional bank to bank deal, it's like, I don't want to think about it. And how much do I get paid personally kind of thing. So there's a mindset that goes in the beginning of having a board and a CEO that, or even a management team that are even open to, exploring this. And then the next step is you have to look at uh, the partnership. You had to interview them. You'll probably look at getting a market advisor, capital markets advisor. You'll get legal assistance. And I know that banks sometimes have tried to do it on their own, but if you don't structure the deal agreement in a way that's really quality, you can run into a lot of problems. You're going to get a letter of intention or, some kind of a legal document that says, okay, we're going to enter into this. We're going to be quiet about it. And you're going to start your due diligence. And so you're going to really want to do a deep dive, both the acquirer of the bank they're acquiring and also the bank that's being acquired will want to look at what deal am I doing? Because if it's a stock for stock deal, you don't want to end up with shareholders, losing out and getting a worse stock. You don't want to have a deal going and find out that they can't pay. You don't want a deal that won't get approved by the regulators. For example, I saw banks that go in deep into the process of, a cannabis type of actual bank, and then only to find the regulators wouldn't approve it. So all those are important. You're going to do a fairness opinion to make sure that the shareholders are aware. But the biggest steps are not only with the regulators and the application process and all the discussions that takes place there, but first things first. Do you, as a CEO and the inner circle, agree this is the right deal for everybody? Is the board aligned? Does the board approve the deal? Next, the shareholder. Do you have a majority of shareholders that are going to approve the deal? It's like you don't walk into a room without knowing what a vote outcome will be. It's just like you don't put this deal out to the shareholders without knowing that there's going to be, general reception. Then you got to put a notice in the paper. Polo was talking before about that rules by the regulators about, not having too many deposits in one area. You've got rules about, community reinvestment. So you have to put a notice out and you might get customer complaints. So there's a whole bunch of hurdles along the way. In addition to getting regulatory approval, usually at, state, federal, that could be SEC, could be OCC, Fed, if you're state charter of the state. So you have like all these different audience that you have to dance on a pin for. So, it's quite a heavy process. And that I think that's why now the deals take, a couple of years and you really have to be committed to it. And it can, it can be a lot. I find it extremely exciting. Even when the deals fall apart, which they often do, it's still exciting to me.
Goodness, I likened it to a wedding. I only had to ask my wife's dad if it was okay to get married. Never mind 4,000 people around it. But yeah, the complexity is amazing. But again, so it should be, right? This is a highly regulated industry, and actually the provision of access to operate within it and within the controls for a customer, within the controls of the shareholders, like all of these things are critical to get right. What are the main challenges then? So we sort of talked a little bit about that initiation phase, Virginia, the akin to that first and second date, right? So, but bringing two banks together, particularly in the US, where we've got very different regulatory requirements across states. I mean, this is not just sort of a merger and it's done. Actually, suddenly you've got, two sets of parents to deal with, haven't you? I'm taking that dating metaphor far too far. I think I'm going to stop it at this stage.
Well, I mean, I think, it gets pretty complex. You have to make sure that you are, I think not tripping up like antitrust factors in terms of deposits and whatnot, but you also have to make sure that your merger is not harming the community in any way. You're not removing loan options. You have to make sure, obviously that the buyer is in solid shape, right? And can handle being a bank, but it's typically banks acquiring banks, so that's not usually a big hurdle. But you also have to make sure, I think, and this tripped up TD apparently when they try to buy First Horizon in Tennessee. I think the Wall Street Journal reported that TD had some questions from regulators relating to its money laundering practices, and that kind of thing can and apparently did scuttle that deal. So it's definitely not easy. You have to go through a bunch of steps. And I think, the Biden administration is taking, kind of raising the bar. I don't know that they've kind of changed the policy formally all that much. They put out new guidance and even the DOJ, which usually does not raise issues with deals, has said it's going to take a closer look at not what has traditionally been defined as antitrust issues, but kind of a deeper dive at products and potential concentrations in products, loan products, that kind of thing. So it's it's a tough process, and I think getting somewhat tougher. I think the bar is being raised clearly for the bigger deals. But I think, I think what the banks struggle with is they know the bar is being raised, but they don't really know to what. So I think that kind of general uncertainty and not necessarily knowing whether a deal is going to happen maybe decreases some activity. I mean, the banks do check in with the regulators kind of informally, is my understanding, just to see like, hey, would this be totally off the table? And if they say no, then you're just not going to announce it. So you kind of have some sense of where regulators are going to go.
They just say it in a really abstract manner, like how my children talk to me. So just hypothetically, just saying, okay, if I was going to do this thing, would that be okay? Not us, but somebody like that type of way. Yeah, that does happen, I understand. But I guess, I mean, maybe on the customer side of things with that respect, because we talk about banking like it's sort of a kind of an amorphous blob of organizations, but all around the world, every bank that is now massive, Chase or, HSBC or, whoever, started as a tiny little organization with a really sort of like specific purpose, and it's almost like what we're seeing with fintech now. Fintech is kind of focused on very small slices of communities or demographics, and they've sort of, HSBC and Chase got carried away over the last 200 years and now they're huge, right? But is there a danger with these types of acquisitions that, particularly potentially, Virginia, with community banks that are a little bit more sort of purpose driven, is there a danger that they potentially sort of lose a little bit of that purpose or lose a little bit of that focus?
Well, it's interesting that you asked that. So you look at the customer, and you could broadly talk about a customer, but you really have to look and drill down. So, for example, in the community banks that I worked with in a rural community, you're going to have a different community customer base, and also you could have elderly folks, or the seniors, or sometimes lower income, that really want to walk into a branch. They really want that, face-to-face banking experience. And that's very costly. And you have to have brick and mortar, you have to have, tellers, you have to have, there's just a lot of different high costs related to the branch experience. But, for fintechs, they're looking at the electronics. It's a very powerful experience for the customer and the bank to scale up very quickly. So you look at some of the fintechs, and the world is changing, and younger customers don't necessarily want to go in a branch, and they want to do it on digital. They want it to be fast, they want it to be easy. And so you can scale up very, very quickly as a fintech. So it's a really funny thing, though, that the regulators still have regulations on the books that are set up like, where your deposits are, or, community reinvestment and stuff like that for the old traditional bank. Whereas a fintech, they're exploding, and they're matching the business plan to where they see the future of financial services to be. That's not true in every case. You saw, I think Chase was starting to open up branches. I heard of a concept the other day called a global banker. And I'm like, what is that? I had never heard of it. So a global banker is someone that anyone could contact and pretty much pay a fee, and they do all your banking for you. So it's highly transactional. They're going to put your funds in whoever has the highest rate and yank them out real quickly. And I said, well, geez, that's like a glorified teller. It is a global banker. And you see some young people that maybe don't want to walk in a branch because they're either intimidated or don't like it, but they still need hand-holding because they don't know exactly what to do with their money, or how to set it up. So there's a whole different customer base, and community banks used to be successful in having a niche or a community that they serve, and it's just it most of the time is not cost effective anymore. Unless you're a CDFI, low income, uh, sometimes you get, grant capital relief because you're catering towards low income or a certain, minority. So there's all different exceptions to the rule. But generally, you could scale up much faster and are more efficient as a fintech.
Yeah, I mean, it's an interesting challenge, isn't it? We sort of make the argument that not all the things that we use are necessarily good for us. I mean, look at fast food, right? It's like, yeah, it's super convenient, not great for my cholesterol levels. So like the idea that financial services is sort of moved to this self-service positioning is really not great for a lot of people, because at the same time around the world we've got financial education at all-time lowest level. So like the idea that an app and me picking from a list of things what I should do, the idea of that, what sounds like a sort of a private banker in your pocket, that sounds like a good idea. But essentially you've got to sign away almost power of attorney for that person to make decisions on your behalf and move money around. But it is an interesting point that you make on the regulation being fit to essentially the more of the physical setup in terms of branches and property and people and all of those things that come with it. Whereas obviously as you say, in a digital world, then the operations should scale in a way that doesn't necessarily reflect the way in the regulation. But I guess sticking with customers though, the point that you were making there about ensuring that the consumer essentially is protected and benefits from these types of mergers. How much does the regulator look at that then, Virginia?
Well, the regulators have compliance rules and regulations, and you're talking about, dancing to two different regulators, the state and federal, but it's actually usually a lot more. You've got, in the United States anyway, you've got the state, you've got the federal, your primary regulator, which is probably the OCC, FDIC, or Fed. You've got now the CFPB coming in. You've got the SEC. You've got then you've got your auditors, internal auditors. I mean, there's just a lot of eyes overseeing the process. So all of those are involved in a merger acquisition. So not all of those, but depending on the case, they could be, I should say. So they're all also looking out for the customer. So you're looking to be able to demonstrate that you're serving in a manner that fits with the compliance rules, which include Bank Secrecy Act, privacy. In the state of California, you've got like these really rigorous privacy rules. You've got, you have to know your customer. If you're electronic, how you're going to set it up so that you meet the traditional, face to face. How am I going to set it up? Just stupid things like, well, not stupid, but for a long time, the regulators wouldn't accept an e-signature. So how do you do that? So the actually knowing your customer base, treating them fairly, all of that is part of the process of a merger. So that's on the end of, getting acceptance by the community and by the regulator. But also you have to look at, where do you make a buck, and how do you serve that customer base that will be willing to trade a service for a cost. And that's being heavily regulated now. So you see in the United States, I don't know if you've noticed, but the fee structure is being very heavily regulated. We're being very criticized, and we're limited on the amount of fees we can charge in, if someone goes over or doesn't pay timely, or doesn't make their payments, or credit card fees. All of that is subject to a lot more regulatory structure and scrutiny, and the fee structure is really, you have to swallow whatever the regulators say. So it's a whole different world, and it's changing quickly.
Hence why big banks have so many people working in compliance and regulations and all of these things as well. It paralyzes many organizations, doesn't it, as well, in terms of just the sheer number of people. But Polo, I guess touching on those points when it comes to, the impact on consumers, and brand is always a consideration here as well. You could go through this whole process and then end up without even changing banking with another brand, which is a bit of a weird experience for people, right? All these things need to be considered, don't they? Because again, the ROI is based on you retaining these customers you acquire, right?
Yeah, certainly. And I mean, I think one critical point of that as well is like, even if you're a big bank just doing the basic stuff, right? I think we're talking a lot about kind of the approval process and whether regulators might sign off on a merger if they deem it doesn't harm the community or even benefits it. But, I think after a merger, and I don't have hands-on experience here, but like, a lot of things need to happen. You need to, you've got customers at one bank and at another bank, and then you have to figure out, okay, well, which app are we going to use, or which digital service are we going to use, and you have to migrate one to the other. And I think we've seen, well, one of the bigger bank mergers, Truist, in the kind of southeast and east coast of the US, they merged in a pretty big deal, I think, in 2018. And, they didn't do some of that basic blocking and tackling quite right. And, I think customers were frustrated. I think we and others have reported on that. And, I think this is kind of a thing that you saw, I think in the 80s and 90s when, there was this kind of start of consolidation in the bank industry. You just did not really merge the systems as well as you could have. And, it's still to a certain extent a problem. And, and I think that can really throw off, the rationale for a deal, because if, you make your customers angry and then they go to a bigger bank, then, maybe it was all for nothing.
It's funny that point on the technology part's never been really integrated. The amount of banks that we work with, and it's like sedimentary rock. You sort of see the layers and the layers of stuff that's built on and built on and built on, all the way back to the sort of mainframe COBOL stuff. And it's the ROI was based on, hey, we were both doing these things, we should consolidate, but often that just doesn't happen. But I guess sort of this all sounds sort of quite scary, and I guess again, it's scary for a reason, right? And again, I come back to being a bank is like quite a serious thing. Like the regulators don't give out charters to anybody. It's not like 6 Kellogg's boxes and you get their free banking charter, right? So there's many instances of this going pretty wrong, right? Do you guys want to mention? I mean, I can mention a few, but do you guys want to mention any particular ones that you've seen that actually probably they didn't really pan out in the way that they thought they would?
Well, I like to just respond to that in general, because I've seen a lot of bank mergers gone bad in the years that I've been around, and there's usually a theme of why they went wrong. For many of them, there was no integration plan. So you do an acquisition and it just doesn't stop on the day that you announce your full new charter. You have to have an integration plan. You have to have a business plan, a strategic plan that you stick to, or kind of change for a reason. But there's a nuance to it that you almost can't put in writing, where you're looking at usually a combined management team and combining cultures. And it really takes a finesse. I happen to just love it. I thrive on it because it's really putting two different bodies together and really trying to see how they can work. And it's a different dance and a different negotiation. So it's almost like a country taking over a country, and with two different cultures, and then being respectful of the way the different cultures work. It doesn't always work that well. So there's a couple of reasons why I think it doesn't work. One is no integration plan. Another thing is egos. So people come in, the management team, they think they do it the right way or the best way. That could be even at mid-management. They're unwilling to change or learn, and things go haywire. You have to be in touch with your customer base and make sure that you're serving them, and also the new shareholder. So there's so many different stakeholders. I will say that with fintechs buying banks, you really have to have a reality check on compliance, and also not have a little humility. Even a bigger bank buying a smaller bank. I can say this as a small-time community banker, and you may not agree with me, but I think there's a lot of value with these small-time bankers. As a community banker, you wear every hat. I have done a lot of merger and acquisitions kind of in the same manner as some of these large multi-billion dollar bank deals. And I have a wealth of knowledge. And sometimes that's poo-pooed because A, you don't have the technology experience, you don't have all the big mega bank name title or come from an Ivy League school. So I think really just putting your ego aside, looking at who has the strengths, how do we merge them, and how do we serve our customers in the best way? And let's move forward in a mode of harmony. It sounds kind of spiritual, but it's really true. It's like, how do we all get along and make this the best new organization that we can?
Yeah, I think that's a really good point, and one that, as a reporter, it's just hard for me to like discern that, right? Because I don't work at a bank, and so I don't like, you just see a deal happen, and you assume that, sure, they're smart business people, they'll figure it out, but that kind of culture stuff, it really does matter in ways that, I think Virginia spoke to quite well, because it's also think about, just a workplace with a different culture than you'd like, or even just, you don't know, right? In this merger process, you're an employee and, you want to make loans, but, you're just kind of in this uncertain period while there's shareholder approval or there's regulatory approval. So I think it's also a challenge to kind of keep employees happy, because, I think during the time that banks merge, it's kind of other competing banks in the area can pick off employees, and so again, to get the adequate return on the investment, you have to hang on to your loan production folks, and you have to keep folks happy, and I mean, I think that's just some intangible leadership challenges that I think banks really have to sort through, and they talk about it on earnings calls. They talk about the culture is a good fit and whatnot, and and yeah, I think that's just a critical part of the process, and one that is not lasts for more than a year or two, right, as the kind of integration process happens.
Yeah. I mean, it's an interesting point, isn't it? I'd say it's often forgotten what you're saying there, which is, these might be businesses, but every business is just a collection of people. And actually, I mean, it's like organ transplant, isn't it? Does the organ reject the host, or does the host reject the organ? I mean, it can be 50-50, but either way, it's a bad outcome, isn't it, in terms of the way in which that pans out. So that sort of merging of the people in that process, the cultures, the rituals, the rhythms, the sort of belief systems, I mean, that has to be as much about to your point, Polo, in terms of the due diligence that is done at the beginning of those things, because many cultures won't mix particularly effectively. So is that? Do you think is that maybe the real ROI that you want to see from this? Is that maybe the real way we would measure success? Is that the right customers and the right talent remains post merger? Maybe starting with you, Virginia.
Well, of course, you want to see the ROI increase, or you want to see a long-term plan, and patience is always golden. So in the long term, you want to see a return, and I think realistic goalposts, and success to me is measured by the shareholder, the ownership value. So of course you want to see ROI as as one of the goals of the new organization. You also want to see customer satisfaction, and you want to see how you serve the community. I mean, I think you're in banking because you want the ROI and you want to make money, but there's also, I think, a real it's sort of a community spirit, which you do want to serve your customer. You want to make things right, and you want to see it last over the long term. And I think that's the value proposition. So ROI, like you say, is very important.
100%. They call it financial services for a reason, right? They're serving the customer bit is pretty important. Polo, what do you think? How do we really measure then the success of a merger?
Yeah, no, I think the points Virginia made are great. I also think it takes some time, but I think once you have challenging times and a bad cycle, it's how much money do you not lose, right? And sometimes with mergers, this is also part of the culture side is one bank might take more risks than another, and so if you are able to kind of integrate the banks and kind of keep a somewhat conservative underwriting, right? Return on investment also means, don't lose your investment when times are tough. And so to the extent that you can kind of keep the right controls there, I think it's critical. And I mean, and that's the kind of thing that right now I think is, we've talked a lot about the regulatory picture and regulators getting somewhat tougher on banks, but I think the banks don't really want to merge right now as much because high interest rates are making their businesses somewhat difficult, but also they don't really know, they trust the health of their loan portfolios, and they trust that, yes, my loan to this, suburban office building is good, but how can you trust that the other bank's loans are good? I mean, there's numbers and stuff, right? But I think it's that kind of thing that I think banks are finding a little bit tricky right now. Is you don't necessarily want to merge because this is a time to kind of hunker down if we do get some sort of high rate recession or whatever. That's the kind of stuff that can frankly wipe out bank equity in the worst of times. So,
well, and that's why I think the world is sort of different than it was, mid 90s with, crazy sort of NatWest buying ABN AMRO and, the world imploding. And, actually it's very different, isn't it? The people who are acquiring, the risk in the market is very, very different. I think actually the market sort of corrections that we've seen around valuations and structures and, and these things called interest rates being a thing again, it's all changing the market, isn't it? But I think we could probably talk about this for like several more hours, but I think we sort of conclude that there's a lot of paperwork. There's a lot of process. It sounds like there needs to be a hell of a lot of patience as well to kind of, deal with that structure and everything that goes. It isn't a short-term thing. It's definitely not a weekend fling, Virginia, to keep, keeping this metaphor going. It's a long-term relationship that people have to sort of build on those things. But I think what we'll do, we're going to stop here and then let the rest of the team unpack this a little bit more in the next episode. So we're going to have to wrap up the discussion. Next week, though, my colleague Kate Moody and Dave Morris are going to be picking up where we left off. In part 2, what they're going to be doing is chatting a little bit more about really what happens internally during a merger. Dave particularly has got some really great experiences being inside one of those organizations when that's going on, and the impact that has on the systems, the process, and the people, as we've discussed as well. So at that point, we're going to have to wrap up. So thank you so much for joining me. Where can people learn a little bit more about you? Virginia, starting with you.
Okay, well, it's been an honor to speak with all of you today. All my discussion items have to do with my opinions, and I represent myself, not any of the agencies I work for or my employers. I can be reached on LinkedIn. Again, my name is Virginia Varela. My email is vavadvisory, which is the name of my consulting firm, vavadvisory@gmail.com. Well, it's not a consulting firm, but soon to be.
Very good. You heard it here first, folks. Polo, where can people learn a little bit more about you and all the good work that you do at American Banker?
Yeah. So AmericanBanker.com, we've got a great team of reporters that, post stories daily on a bunch of issues. So definitely check that out. You can find me on LinkedIn as well, if you've got questions or complaints or any of that kind of thing. But yeah, AmericanBanker.com, we've covered the industry in and out.
Very good, very good. As for me, you can find me lurking on LinkedIn. It's where I spend most of my time these days, I have to say, with this social media of choice. Thank you so much for listening, everybody. If you do...
We're going to pause here for a quick break before we delve into some of the challenges that banks face when the deal is signed and the messy processes of merging tech stacks and company culture begin. It's all coming up after a quick break.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Cora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's vanta.com/insider for $1,000 off.
Entrando em contato com atendimento ao cliente. Para muitas pessoas é um jeito fácil de arruinar um bom dia. Mas na Zendesk, nós deixamos a experiência do cliente melhor. Melhor para sua avó, melhor para o seu vendedor preferido de flores, melhor para o cara do apartamento 3A, melhor para você, melhor para todos. Porque enquanto alguns dizem que o cliente sempre tem razão, nós dizemos que o cliente é sempre humano. E como seres humanos, queremos fazer algo melhor para todos nós. Zendesk, experiência do cliente com IA desenvolvida para humanos.
Welcome back to Fintech Insider Insights. Before the break, we looked at how one bank can go about absorbing another. Now, let's take a look at the nuts and bolts of what happens when technologies, and more crucially still, company cultures, collide. Earlier this year, 11FS's Customer Strategy Director, Kate Moody, sat down with Dave Morris, Global Head of Technology at 11FS, Rupy Malizia, Chief Strategic Transformation Officer at HSBC Innovation Banking, and Varela, a fractional Chief Operating Officer.
Hello and welcome to Fintech Insider Insights. I'm Kate Moody, Strategy Director here at 11FS. In the previous Insights episode, we kicked off our two-part special on how to buy a bank, where M.Brear and guests covered what actually happens when one bank decides to buy another. Today, we are diving deep inside banks to uncover what really goes on inside the organisations themselves during a merger or acquisition once ink is dry and the businesses now have to work together. The process of actually combining two banks can take months or even years as departments, systems, processes and people are brought together under one group. Not only do banks need to consider the practical things like which IT systems to use or how to get everyone from one email server to another, but there are also wider, really important cultural challenges. So how do you combine two workforces and two ways of working into one harmonious company to set up for long-term success? To have this conversation, I'm really excited to be joined by an amazing panel of experts who have themselves been through a merger or reported on them or generally experienced them and been there in the midst of them. So firstly, I'm delighted to welcome Dave Morris, Global Head of Technology here at 11FS. Dave, I think this is the first time we've hung out on the podcast together. For those of you people who don't know you, what should they know about you and what you do at 11FS?
Yeah, it's the first time on the podcast for me. So I head up technology delivery across 11FS as a group, whether that's in our products, on our consulting or wider than that. Previously, I've worked at various combinations of startups and big organisations. I think importantly for this, I was nearly 10 years at BNP Paribas in the wholesale banking team, and I joined there at the start of the merger of Fortis at the end of the financial crash, and went through some of that journey and the interesting challenges that were part of that.
We're going to dig it all up today, get all those skeletons out. So yeah, absolutely. Well, thanks for joining us and looking forward to getting your take as we walk through. It's also a massive pleasure to be joined by Rupy Malizia, Chief Strategic Transformation Officer, HSBC Innovation Banking. Rupy, thank you so much for taking the time out for what I'm sure is a very busy day to join us and share your experiences. Tell us a bit about your role and what you focus on.
Hey, Kate, great to be here. So my role is really to enable our organisation to grow and to scale as well. And that covers all the kind of aspects that you've just talked about and mentioned around process, operating model, systems, technology, data, but also a bit of a bent towards innovation and creating an innovation ecosystem internally as well as dealing with or working with our clients externally from an innovation perspective as well.
Awesome. Well, yeah, thank you so much for joining us and looking forward to hearing from you as you go through the episode today. It's also a pleasure to be joined once again by Varela, a fractional COO. Varela, welcome back to the show. Again, if listeners haven't come across you before, what should they know about you and kind of what you're most interested in and doing day to day?
Yeah, thanks for having me. It's great to be here. So as a 3 times founder, I help venture-backed companies towards profitability through the power of systems, automation, and demand generation. And on the corporate front, which is the topic here, I played at the intersection of corporations and startups, driving growth and innovation through partnerships, M&A deals, as well as strategic investment in corporate venture capital. My background is diverse. Yes, it is financial services, fintechs, but also into tech as SaaS, health tech, and renewable energy. So this helps me bring a more nuanced approach to my clients.
Awesome. Well, yeah, excited to pick your brain as well. So, I mean, got lots to cover here. So let's dive in. So in 2023, there were 3,230 M&A deals in global banking and payments, according to globaldata.com. But the process itself can take up to several years to complete, depending on the size of the banks and organizations involved. When we think about mergers, it's pretty easy just to focus on the big picture stuff we covered in part one, but really, I think this is just the start of a very long, complicated process. Once that deal is agreed, banks must bring together all of their resources and their systems about impacting the customer. So I'd love to get all of your perspectives on what that actually looks like and feels like on a sort of day-to-day basis inside a bank. Mariella, maybe you could start us off from your experience of M&A, mergers and acquisitions. How early on should companies be starting to think about the factors like the tech, the systems, and the operations and how they come together? Would it ever be a deal breaker to a deal actually going through in the first place?
Yeah, I think first of all, every deal is different. So the most seasoned M&A teams have a pretty solid playbook. And even when you have opportunistic deals, those can be adjusted. But I think it's critical for the team to remain agile and continuously learning. This is super important, not just on the tech side, but everything is always new for when you move from one deal to the other. The thresholds to get the deal done to be well-defined on the onset are high. And this is reflected in the deal activity, including, as I mentioned, opportunistic deals. Secondly, on the technology, I would say the bar on due diligence technology has increased because there is increasing certainty on the cost efficiency and delivery of returns that's still high. And many banks have been burned before when they compare the target outcomes to actually what happens. So there is increasing scrutiny and much better, I would say, resourcing of the team when they conduct the due diligence. Personally, on this point, I'm an advocate of integration team-led diligence. So that means bringing the right people to ask the right questions earlier in the process.
Yeah, that sounds absolutely critical. Rupy, really keen to bring you in here. Obviously, it's been less than a year, or barely a year even, since you guys were SVB, Silicon Valley Bank UK. And it was a pretty unique coming together, right? Happened in a fairly short window of time. So firstly, kind of how did that shape this kind of consideration process that Mariella set out? And yeah, what's the transition been like? Where are you guys up to right now?
So actually, not only was it a unique purchase, but I was in a unique position. And the reason being is that I worked for HSBC prior to joining SVB. And I'd only actually been at SVB for 5 months. So I literally left HSBC, joined SVB, got to grips with what SVB is all about and our client base and our technology platforms and how we operate, to the point where in March we obviously had the contagion impact and we had the weekend and we were purchased by HSBC. So for me, because it was very familiar and I understood the tech environment very, very well, the way that we're constructed within HSBC, it gave me a level of confidence that actually I knew that we could call upon many different people around the world to bring that expertise in. And we had a natural trust there because they also had myself in that role in SVB. And I think that really helped with that kind of engagement with the transition team. We actually didn't call it integration. We actually took a very different approach. So, Mariella, you've talked about playbook. I previously was part of the team that did the HBOS to Lloyds integration, and that was 32 million customer accounts. So it was a massive integration at that point, that was very much a playbook, and that was over 2 years. This was a very, very, very different proposition. We executed the transition in 100 days, and that is really unheard of. And that's getting onto the technology platforms from the previous parent group that was now bought by another organisation. So we didn't really belong to them, but our data assets and our client information was there. And we needed to quickly get that across. So I think knowing that the expertise existed in HSBC technology and being very close to them, I knew and we knew that we could get across in an effective way. And, it was every aspect of the organisation. So, when we did the transition, integration, we were across about 20 work streams that were jointly coming together from our side and from HSBC side to work together very collectively and collaboratively to get to the end result. It was tough because 100 days, Marielle, I'm sure you know this, that's quite unheard of. It's very unique. That was a technical cutover, ensuring that our clients were in a position to operate. We could operate the bank as well on the Monday after the weekend happened. So there were many different factors we had to think about, Kate. But collaboration, trust in the process, making sure we had a voice at the table was really, really important. And I think having me in a unique position, understanding HSBC, did have that sort of unique aspect to it, which helped us bring it together in a smoother fashion.
Yeah, absolutely. I can imagine that must have been absolutely critical. And as you say, I'm fairly confident, 100 days will be fairly unique is the word you used, I think, correctly. So it's probably a challenge to identify like one particular component of that was the most difficult, but I'm going to ask you to do it anyway. I mean, what was the hardest thing to manage as part of not that integration process, I suppose, but this transition more broadly?
So I don't, because having done quite a large scale integration before, I knew what to expect. So on that side of things, integrating into an organisation, transitioning into an organisation, I knew would be fine from the nuts and bolts of it. The key thing was going to be the cultural aspect and ensuring that we kind of maintained the SVB culture, which isn't that dissimilar from HSBC, but probably is a little bit more, a nod towards the innovation style of approach. So that was one area that we had to really focus on and treat with care. And HSBC were very respectful for us as well to do that. The second aspect was actually the technical migration of a organisation's platforms that we no longer belong to. That was very, very difficult. And that required quite a lot of negotiation with a company that we didn't belong to. And that took quite a bit of time and effort and conversations in San Fran to get us to the point that we could do that full transition. So a lot of negotiation there.
Absolutely.
That was the harder bit.
Hopefully a lot of biscuits consumed, at least. This is always my key requirement for any kind of like difficult meetings is plenty of biscuits. But Dave, obviously, you live and breathe the technology. Maybe for our listeners who aren't as technologically orientated, can you dig a bit deeper for us? Like, what does it actually mean to merge systems in a business? Why is it so hard?
Yeah, it varies massively depending on what the merger is. If you take the SVB case that Marielle's just talked about, that's a carve out effectively of you have to get off those tech platforms, and so there's a push there to move you from effectively technology platforms you no longer own. But in other scenarios, you see different complications depending on the scale and things. So if you think about the Fortis merger with BNP Paribas that I was part of, that was two multinational banks being brought together with everything from retail to investment banking and beyond in each of those. And so a lot of that was about identifying where are the commonalities, the overlaps, what can be brought together, what doesn't make sense to bring together, and where do you want to have a single culture and where do you want to keep it separate. So very much on the retail side, they wanted to keep that very separate, and they wanted Fortis to own an identity still in Belgium. But when you started to look at investment banking and things like that, they very much wanted to focus on consolidation and bringing those things together. The challenge, I think, on a lot of the technology is you tend to build banks in vertical product lines of tech stacks. Now, that's, in some respects, makes life easier because you can pick and choose and say, well, we don't have overlapping business lines and product lines, so we bring this one forward and this doesn't exist elsewhere. But it makes it harder where you start to look at those monoliths of stacks and how do you actually pick the right one and bring the nuances of migrating customers onto those stacks in there, because effectively you're trying to lift data from one world to another. And over time, where those stacks, particularly in the core banking areas, have been built, a lot of that is knowledge that's lost within the organization. So you're almost having to reverse engineer some of the knowledge of how that's managed and how that data is used. You think some of these systems are 10, 15, 20 years old, particularly on the mainframe side. And that makes life really, really hard as you lose a lot of that knowledge. And so you're almost having to reinvent things in there. And I think that's why they are the areas that take the most time and are often the early focus from a technology piece is around the more common capabilities that actually get you some quick wins. And I think that the tech teams want to be able to show that they're adding value and reducing the cost base as quick as they can. So they'll pick on some things that they can get the quick wins on. Common capabilities like KYC or payment engines or central party management systems or CRM systems, where it's easier to bring some of those things together because they tend to be newer, they tend to be more modern stacks, that they can bring those pieces together much more easily, start to see those wins and start to actually, you build momentum in technology from wins on those things. So that's often where you see a lot of the focus on those things. But it's never one size fits all, because the complexity of the organizations, it's not about the technology ultimately, it's how you use the technology. So you weld it into the operations, into the processes around them as much as you are the technology itself.
Varela, did you want to come in?
Yeah, Dave, so happy you mentioned data, because in my experience in bank-to-bank integrations, migrations, the focus is almost 90% on the tech. And data, I've seen it being almost like an afterthought. And this is such a massive component if you get the data wrong further down the line in terms of really understanding it pre-migration. I'd be curious to hear, why do you think this is happening still today? And what are the key changes you're seeing in terms of data integration and migration?
Yeah, I think there's a lot of movement from that world that was everything was focused around a P&L of a product line, and so data was in silos, and as you'd start to see some of the things that happen, with some of the big regulatory changes around BCPS 239 and things, where people had to understand and be able to communicate their data more holistically as a bank, that's forced to think about data as a more horizontal view of the world. You now have people who are dedicated to roles in those places that understand that. And a lot more banks have started to really see the value of having data brought together. And so I think that makes life much easier. And, but a big part of my role at BNP Paribas was owning, data platforms globally. And, it's dear to my heart on that side of things. And I see that's, how important that is. But if you get that right, that's massive value. If you get it wrong, you're dead in the water almost from the beginning, from my perspective.
Yeah.
I'd probably just add to that as well. So I think that I would totally agree with both of you, actually. What I would say is that for the SVB transition into HSBC, data was a forefront of our conversation. So that's part of the extraction out of a parent group or a group that we didn't belong to any longer. We had to get that data out. So, we would have multiple meetings on data every single week. The extraction of data, how we're going to do it. We closely manage it. Executive teams, myself and our COO as well, were all across it. And then, moving into an organization that has established tech platforms, global tech platforms, understanding where our data is and how it's structured, and then how we can use that from a future-proofing perspective. So I think for us, it's, I think it was a very much a data-led transition on all aspects, as well as, underpinned by technology. And our continuing conversation is now on, okay, we know the data's in a very complex landscape of technical architecture, but we now need to make sure that we're future-proofing it. So when we move into things like Gen AI, it's no good if we don't have the data constructed in the right way. So when we start to do a nod on innovation internally within HSBC Innovation Banking, we are priming on those conversations to look at, okay, we've gone through a 100-day transition. Now, that means you've still got cleanup to do and you've got to get everything sorted out. Your focus is client. Your focus is also regulatory and financial reporting. And also from our colleague perspective, that's the sort of stage 2. The stage 3 that we're doing in parallel is very much around how are we going to think about our data strategy and our data platforms in an innovative way, utilizing what HSBC has to offer, but taking it a step further. So we're almost priming for exactly what we're going to do in the Gen AI space or any other kind of innovative technologies that we want to be bringing in to assist our clients and also to assist from a colleague perspective. But if I went back to the previous integration I was involved in, I didn't feel that the data was as as important. It was important from, moving 32 million customer accounts across to different tech platforms, and that was a key financial control and operational control. However, it wasn't as primed as a conversation as it is currently at the moment. So I'm definitely seeing a shift there.
Yeah, I think as people start to think about the whole AI world and things like that, there's so many people who are talking about it as a buzzword, but actually, ultimately, if you don't think about the quality of what you're putting in at the bottom of that, it's irrelevant. You're not going to get anything out. It's that whole, rubbish in, rubbish out concept we've always talked about in, back from the traditional reporting days through, it still holds true for AI. So
No, I totally agree with you. There.
Yeah, absolutely tons of things to think through. Obviously, it's a hugely complex process. Mariella, we've been talking a lot about the internals of these organizations, but I assume lots of these things can't happen in silos. What are the dependencies around these banks, these organizations? Obviously, they need to be having huge amounts of conversations, negotiations internally, but how many other teams are involved in managing these kinds of mergers and acquisitions outside the banks or the fintechs themselves?
Yeah, as I think we keep saying, every deal is different, every seller is different. So we're just talking to hear trends. I would say before even the deal gets done, and I like Simon Sinek's book on finding your why, before embarking in any transaction, having super clarity on the why this transaction is happening in place, it should guide everything else, because every transaction is quite unique. So more recently, the deals that have been involved have been on technology for some of the reasons you guys mentioned earlier around AI and other key strategic technologies that companies are acquiring. And when you think about a deal around technology, the guidance typically is around the asset and the IP. But in most cases, about the people who created the technology and who will maintain the technology. So you now take a shift, not just from the technology, but a huge stakes in terms of retaining those people on the packages and the culture that they need in order to stay. Because it might well be that, you have a large corporate that has all the capabilities to absorb them and the most amazing M&A and integration teams. But if that team, regardless of the packages, is not willing to transfer because of culture or other issues, the whole deal is dead in the water. So that's just one example of being very clear on the why. Beyond the questions of the why, I would say we talked about what does it mean to have the transaction done, and every single work stream level, because both the buyer, the seller, and every single person that was involved in that transaction wants to know, what does it mean to be done from every aspect. And so some of the definitions, for instance, are: what is the end state on technology architecture? What is the end state when it comes to customer value props, the products coming together? What does that feel for customers and across everything? There's just the online experience, the mobile, the channels, what products are they going to have, pricing, everything has to be defined. And some things like the consolidated geo footprint, properties, another, I think still big one in larger banks. So what does it mean in terms of the employees working together? Back to the point of culture, that could be hugely defining, right? So having that why in the first place, and then the end state, and how do we know when we're done? I think that's some of the key ingredients to this.
Rupy, are you done?
Yeah, no. Well, we're done on the bizarrely, we are done on the transition, even though it seems like it was quite a fast one. But we've had all the support that we needed through HSBC from the top of the house right the way throughout. And actually, it was a fantastic opportunity for me to see former colleagues lean into the transition in the way that they did. And we were working 24/7, and we were probably around 700 to 800 people across both sets of organisations, and probably more across 20 work streams. And when I say work streams, I mean marketing, legal, HR, technology, every risk, every aspect that you could think of that as a bank runs. There were people from every single team. And not only were they working on a day-to-day basis, they were on every single weekend, night shifts, day shifts, etc. So we were working incredibly fast, but as a single team, and that's what we strove to do. We have got things that we're finishing up, but actually it's not as bad as I thought it would have been. And I think we're nearing conclusion on that. But we've fully transitioned. Clients are fully operational. Got full access to our customer service, and our relationship management teams are out there. our organisation is operating. We're out in the ecosystem from a banking perspective, but also from the innovation networking perspective. So I think we're at a point where we are just, it's, dare I say, BAU. There will be always things that come up through the year, but they're just things that we would just deal with. And it's just into growth mode and scale mode now.
Okay. Well, no, that's awesome to hear. Yeah, so obviously you were outlining kind of the huge effort that had gone into the work you've been doing at SVB. How do you take staff with you on that? How do you avoid them all just like collapsing in a heap halfway through? Like, it just sounds like such a huge workload.
It was a huge workload, and we had constant communication with our staff. So we were on site all the time. We had regular updates. So we were very transparent with them as well. I was certainly doing weekly updates as well as our CEO, Erin Platts, was doing regular updates as well. So we built that relationship with them to make sure that what we're doing is in the best interest of our client base and also our colleagues. And they truly felt it, and they knew that we were at the front of the trenches. We were not behind them. We were right in the front of the trenches, and I certainly definitely felt like that. We checked in on people. We've got an amazing HR team that were actively engaging with all of our staff to make sure that their well-being was good. We were keeping an eye on, are we burning people out? Do we need more resources? And one of the things that HSBC was great at doing is to say, look, if you need more people, you just need to say. So let's not oversweat the individuals we have. Let's add in where we need to. And obviously that's sometimes challenging when you've got key SMEs that, you just can't backfill, but putting the right support mechanisms around them was crucial. But part of this journey, if we didn't do the regular communication and also honest, transparent communications, I think we would have had a very different situation. They went on the journey with us. I think what is very unique about HSBC Innovation Banking, formerly SVB UK, is that the reason why people are in the organisation is not because it's a job, it's because they're here for the client base. It's an innovation ecosystem that everyone truly believes in. So there's a strong sense of purpose. So I think for us, having that sense of purpose and drive and wanting to continue the organisation as it is, and trusting the leadership team that we were going to retain the organisation as is, has been a key factor in people coping with the volume of work that they had to deal with. And we're coming on the other side of it, and the teams are still flourishing. It doesn't feel like we went through what we went through, and they are just pushing forward. And the conversation on the ground is, how do we help our clients? How do we get out there in the innovation ecosystem? How do we continue connect front to back in the organisation to make sure that we're scaling effectively?
Dave, obviously the pitch that Rupy describes sounds, hugely positive and very impressive. I mean, I guess it doesn't always pan out that way, right? Like, when do people get this wrong? How do they get this wrong?
I think the transparency is hugely important, but obviously it's not always as simple to come in and say you're going to keep all of the teams intact, because typically, particularly in technology, you want to reduce costs, and ultimately one of the biggest costs is people. So you're going to want to consolidate teams and that. So you do the transparency helps in that, but ultimately at some point you're going to have two teams doing the same things in the two organizations, and one of those, and is there a fight as to who is the better and that. So actually trying to be very clear as to, this is the strategic direction, you're actually one team and you're merging together to become then the target team, but you do know that it's not going to be all of you on that at the end of it. Now, you recognise that some people aren't ever going to be on that journey, and they don't want to be part of the new organisation. And just, so it's a big challenge for managers, really, to make sure that you really are as close to the people and knowing what's going on as part of that, because change is terrifying to a lot of people, whatever change it is. And something like this layers uncertainty on it, because there are things you can talk about and things you can't talk about during these processes, because ultimately some of these things are pure HR things that you have to go through legal processes on that you can't talk about in certain ways.
Mariella, we've kind of had a tale of two halves here. Like, Rupy's talked us through like a really great example. Dave set out some of the kind of more difficult, challenging elements. From your perspective, looking across multiple deals, do you think we are learning from the stuff that goes well and kind of ditching the bad behaviours, or is it not quite as simplistic as that?
Yeah, every organization is in a different trajectory, but definitely the ones that have done quite a few deals before, there's pretty good feedback loops between the teams that are originating the deal and negotiating and the teams that are integrating. So you have that constant reinforcement of, that goes into the due diligence earlier on and then what to do later on. So I think particularly for larger banks, things are getting better. Now, when it comes to deals, when it comes to acquiring fintechs or even, this is all M&As, not partnerships, but you see it in the partnership types of deals as well. There are always so many differences when it comes to the types of transactions when it comes to the fintechs if they have never been through a transaction like this before. Then there's a bit of a learning curve, but also some surprises because when somebody waves a big check, sometimes they say what people want to hear, and sometimes it comes without warranties or the right protections in the contract. So there's always a few surprises there. But I think going back to Dave's point around the people aspect, I would say when it comes to the top front and the exec level and some of the key people, things tend to be really smooth and well. It's when you get to different layers that things get quite complicated. But I'd like to touch on something that Dave said, which is super important. It is people know they've been through quite a few transactions before. And they know that efficiency is one of the major plays of, any M&A. And the best thing is to be transparent up front, being super accountable with clear communications, because when things do go wrong is when you have longer periods of prolonged uncertainty, indecision, lack of clarity. That's a huge burn for everyone. So I would say just move quickly, swiftly, communicate clearly from the front, from the top. Top leadership, as you mentioned, Rupy, is critical, but it has to be very efficient and very swiftly to avoid those long periods of indecision. I think that's the key thing to avoid here.
Yeah, no, absolutely. I'm keen to also think through some of obviously we talked a lot about the culture and the people, which is essential, but I'm also keen to think through some of the practical operational challenges. So banks, for example, have separate offices, like separate working spaces. Rupy, obviously, you were already the UK arm of an American bank, so there were probably like things for you to work through there. But yeah, how's the kind of the physical considerations of managing two businesses or bringing two businesses together been?
Well, I think I've obviously got a positive spin on quite a challenging period of time. So I'm probably sounding quite rosy, but it was obviously a tough transition period. But what I would say is we were on the tech platforms of SVB US. So we utilized all of our tech capability was with them. So all of our tech capabilities with HSBC. So we've kind of almost flipped from one to the other. So it's made it a lot easier. We didn't have any tech teams to integrate as such because that didn't exist for us in the UK. So with regards to property, we have our offices in London, which is sufficient for our size of organisation. HSBC have their property portfolio. And what I would say is it's slightly different for us because we are slightly different to most of HSBC. So they want to keep us as a unique offering for the innovation ecosystem that we're operating within. They don't have a complete like for like within the organisation. They might have some aspects of similarity in commercial banking, but we're actually having really grown up, mature conversations on where best to have that type of activity based on skill set and experience and actually viability from a scale perspective. So we are having lots of grown up conversations there. The HSBC UK COO actually signed our lease for a much longer period of time for us to stay in our offices. So there wasn't a move to say, right, you've got to move over to 8 Canada Square. You've now got to be part of our premises. I have to say there's been quite a mature conversation around how we operate because it's a slightly different banking client to what they're used to, and they want to keep this uniqueness about us and kind of protect it in a way. Now, whatever happens in the future when you scale, etc., that no one can define that, no one can determine that. So for us, it hasn't been that, right, you're now part of us, you now need to come to HCS, you're moving all your teams there. That would have been an absolute mistake to make. And Mariela's point earlier, which is, people have to fintech's being acquired or going into an organization. There's and you have a big check waved and you go, great, this is fantastic. But there's lots of watch out clauses. The company that's acquiring needs to really think through how they go about doing this, because you're going to lose the asset that you've bought as a result of the way that you do it. HSBC parked their playbook. They knew that. They took a very different approach with us, and they continue to take a very different approach with us. We're not separate from them. We are fully integrated, and we work with all the teams within the organisation. We go to the different offices around the UK and globally, but it's pretty seamless. It doesn't seem to be an issue. So from our perspective, it's not been anything really different for us. We had a parent group in US. We've got a parent group across the globe and in the UK. So it's straightforward.
Yeah, no, I think it's such an interesting example. Dave, how big a difference does it make to have teams in a physically separate space?
For technology, it's not such a big deal because we're so used to being disparate and nearshored and offshored and things nowadays. So I don't think it's a big challenge from a technology side as it is in the same way as it is for some of the areas of the business. A lot of particularly post COVID and things like that. A lot of technology teams are still working remote and hybrid, a lot more so than they would have been historically. So it's not that is part of the life that we are as a technology organisation, that we have that disparate nature. It does make challenges of how do you actually communicate and get buy-in much harder, because you're, wanting to make sure that those messages are there. But that's where actually the effort of making the time to travel to those places. I had big teams in India. If you really want to actually get the buy-in and the message there, you go and you sit with them for a few weeks. You don't do that on a Zoom call remotely and things like that. It's absolutely key that you take that effort and you make sure that they feel part of those organisations without the proximity that you get from there. And I think it's just how we've built up to how we are now from that point that we decided that we had to start being, it wasn't all just in one office in London. You've now got, I think when I finished at BNP Paribas, I had teams nearshored in Lisbon and Madrid, 2 centres in India, some nearshore people in Canada for the US side of the operations and things like that. So you end up with that's just the nature of your team, and so you build around that. But it does make communications on some of those change aspects harder, because you want to be able to communicate the message at the same time to everyone. So you don't want it to dribble out, but you can't because they're not working all at the same time and things like that. So it brings other practicalities into some of those things.
Yeah, no, for sure. And Mariella, I was in a not the HSBC office yesterday. I was in another kind of UK bank's office yesterday, and we spent a lot of time talking about the differences between 11FS's flexible working policy and the bank's work from home versus working in the office policy. So I suppose I'm keen to think through. That's just one example of a policy different in employee benefit. Where do kind of differences between organisations, benefits, incentive structures, when do those come into the conversation? When do those start to play through, and what opportunities or challenges do they create?
Yeah, back to, and I'm more in the sort of similar size of 11FS transactions now, moving from big corporate. So I get that is huge in terms of culture, the flexibility, and some of those perks and lifestyle. I would say it's quite critical in those tech companies. But it's very early on. So back to why are we getting this deal done? When you have key players that need to transfer into the new company, keeping the culture and keeping the retention package, but also the right environment for them could be one of the top conversations. Because in order for the deal to happen, if you're talking to the CEO of a fintech or you're talking to another company, those types of conversations will come pretty earlier on in terms of what does it take to get this deal done, especially if it's a value to both players. So those types of negotiations will come in. Now, further down the line, when you look at things as, packages that are much more traditional, health and others, I just think they need to set the bar and stay at a stage where the teams will migrate. But it's all about who are the key people that need to move and what does it take to migrate them into the new company. Now, for the others who will not migrate because of the consolidation efforts, those types of conversations also happen in terms of driving the best outcomes for those that are not part of the integrated entity.
Absolutely. We've spoken a lot today, I suppose, about, and rightly so, about the challenges. Like, this is a huge challenge thing to get right. But I suppose I'd like to close out the show by focusing on, like, trying to switch maybe to the positives. So, Dave, what are the long-term benefits of getting a merger right? Like, what are the positives here? Like, what should people really be focusing on from that perspective?
I think for me, if you bring the best of both parts of what you're bringing together in a true merger, then you have an organisation that is more valuable and better as a whole in that. And that's, I think, it's the true best of the two halves that you're bringing together in that. No merger is ever really truly equal, but actually you should have a more valuable organisation at the end of that, and the best of things, whether you had better packages and HR on one side or better technology on another side and things, you should be trying to maintain and keep the best of those things, and ultimately it makes your whole organisation better as a whole, worth more, and improves both the customer experience but ultimately shareholder value across it.
Fingers crossed. Yeah, I mean, Rupy, what's been the kind of the North Star that you've been holding teams to, or like sharing with teams to get you through this kind of obviously very intense, very difficult period?
I think the North Star is that we are going to be the bank in the UK that is continued to be a leader in the, with the clients in the innovation ecosystem. And I think we have a much more sort of longer term view, which is we work with clients that are going to help make a difference to society, to the world, etc. And I think that we're vested in that. And I think the other aspect of just the North Star on the transition side of things is focusing on the best of both worlds. We have international reach, we have global reach now, which we didn't have before. There are things that we were doing in a 2030 strategy for SVB, which have been accelerated and are in place. And it's just about utilization of that. So I think people can see broader opportunities. So for us, it's very much about growing the business and scaling it appropriately, and also leveraging in a mature way the assets of HSBC that can benefit us, as well as we're benefiting HSBC as well from a broader proposition that they can offer globally.
Well, I think that's a great place for us to wrap up today's show. We could spend hours and hours talking about this. Obviously, it's a hugely multifaceted thing for organisations to do. But thank you so much for joining us. I hope you've enjoyed our short series on how to buy a bank. And if you haven't yet listened to part 1, please do check that out. David Brear chats to some great guests, discuss the bigger process, the regulatory change around M&A, and it gives you all the context you need to enjoy this episode even more. So again, thank you so much to today's guest for joining me. Where can people find out a bit more about you, Rupy?
HSBC Innovation Banking and also LinkedIn.
Fantastic. Dave?
LinkedIn and across all the 11FS content, obviously.
Absolutely. And Mariella, what about you?
Yes, do get in touch. Mariella Hunter at LinkedIn.
And you can find me on LinkedIn as well, Kate Moody or kate@11fs.com. Thanks for listening. If you like what you've heard, follow our podcast and don't forget.
That's all from us on Fintech Insider Insights this week. Thank you for listening. If you like what you've heard, please do follow our podcast and don't forget to leave us a review, which helps us make it better and helps others find the show. As always, if you want to join the conversation, please find us on social media. Just search for 11FS or Fintech Insider or email us at podcasts@11fs.com. Thanks so much. Goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Cora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.